So a point to remember here is that prepaid amounts are excess, so we subtract. Accrued amounts are not yet paid, but the period for payment has already gone, so we add it. So we add accrued. So we add accrued there. And remember, accrued, they can tell you about accrued. Accrued is the same as arrears. It is the same as due. It is the same as outstanding. It is the same as unpaid. So they can use any of these terms, but they mean the same thing. All these, they simply mean that that amount has not been paid, but the business was supposed to pay for the period that has already gone. After doing that, then in number four, we are told about the provision for doubtful debts. The provision for doubtful debts. And here now, we are told that the provision for doubtful debts is to be adjusted to amount equal to 10% of debtors. It is supposed to be 10% of debtors. In this case, then it's supposed to be 10 over 100 times the figure for the debtors, the trade debtors, which is actually 64,600. So if you do 10% of that, you find that it's going to be 6460. 6460. This is actually an amount that we are doubting. The debtors who are actually the credit customers, we are doubting whether they are going to pay us this particular amount. So once you have calculated the provision for doubtful debt, you need to go back to your trial balance and find the figure that they gave us, the provision for doubtful debt, as at 1st of January 2015. And when you go there, as at 1st January 2015, the figure that was doubtful was 9,200. But this year, we have calculated the figure that is doubtful, it is 6460. So this is an increase. It has increased from 64 to 92, and therefore we need to get the increase in provision for doubtful debts. So the increase, if this is the figure that we did not recover last year, and this is the figure that we are not going to recover, or we are feeling that it is doubtful to be recovered, then it has increased. Not really increased, sorry, it has reduced, because this is for the last year and this is for the current year. So if the last year we were having a doubtful debt amounting to 9,200, then this year our doubtful debt is 6460. Actually, it is a decrease, not an increase. It is a decrease. Sorry for that. Decrease in provision for doubtful debt. It is 9,200 for last year minus 6460 for this year. What is a decrease, Agnes?
$27.40.
How much?
2,740.
It has increased by decreased by 2740. This is a decrease. And how do you compute the decrease? You compute the provision for doubtful debts for this particular year, and we were told it is 10% of the debtors. Our debtors, we were given at 64,600, so we just calculated the 10% of that, and we find the figure that is doubtful for this year. Then we compare with the figure that was doubtful last year. If last year what was doubtful is 9,200, and this year what is doubtful is 6460, then it has decreased. The amount of doubtful debts has increased by 2740. And this one we are going to go and add. If it's a decrease, we add to the gross profit as a revenue. We add it to a gross profit. But if it could have been an increase, we could have subtracted it, or we could have treated it as an expense to the particular business. So anytime you calculate the provision for doubtful debts and you realize that there is a decrease, that decrease you add it to gross profit. If it is an increase, that increase you treat it as an expense for that particular period. Lastly, there is an additional information where you are told the provision for depreciation was provision for depreciation was amounting to provision for depreciation was 12% per annum. Depreciation on motor vehicle, we are told it is 12% per annum. So in this case, we are supposed to calculate 12 over 100 times the value for the motor vehicle. The value for the motor vehicle at cost, it is 350,000. But remember, we are told that this particular vehicle, it is per annum using a method we call reducing balance. When you are told you calculate depreciation on reducing balance method, then the cost you minus the provision for depreciation. And the provision for depreciation that we are given here, it is actually 42,000. So in this case, the depreciation will be 12 over 100 times, this one is going to be 308,000, if I'm not wrong. I've just subtracted 350 minus 42,000. I think it is 308. Sorry, actually I was off net. So you must be a bit careful when it comes to depreciation. Sometimes they can tell you that the depreciation is calculated on cost. When it is on cost, it simply means that the depreciation is on straight line. The depreciation is on straight line. But when they tell you it is on reducing balance, then they simply mean that the depreciation is calculated on the basis of the net book value, and the net book value is normally calculated as a difference between the cost. This is the cost that we spend in acquiring the motor vehicle minus the provision for depreciation, and provision for depreciation is simply the depreciation for the previous year, from when this particular motor vehicle was acquired up to the beginning of the year. That depreciation is what we are calling the provision for depreciation. So we want to know, as we were starting this particular financial year, what was the book value of this particular motor vehicle? The book value is simply the cost minus the depreciation that it has lost, or the depreciation that has accrued on that particular motor vehicle, so that we find now the book value is this, and then now we can go ahead and calculate the 12%. So if you calculate 12% of 308,000,
36,960.
36,960. That is now the depreciation for that particular period. So once you have done all those adjustments, that now permits you to go ahead and prepare what we are calling the income statement. You prepare the income statement. And in preparing your income statement, the following format will be followed. You start by writing the name of the business, which is Mueni Trader. And then this is an income statement for the year ended. For the year ended 31st deck 2015, and then you underline this. Sorry, you underline that part. Sorry for that. Like that. So it must have the name of the business, which is given in the question paper, and then you say income statement for the year ended, and then the date also will be given in the question paper. Then you come here and always start with the what we call the sales. And what we mean by sales, this is the amount of money that was realized after selling the goods. After selling the goods in that particular financial year, whether cash or credit, the goods that were sold or the money that we are supposed to receive or the money that we receive is actually 481,000. Remember, sales is going to be found on the credit side, 481,000 shillings, like that. This is the total amount that we have received from selling the goods. But these items that we sold to get this amount, they costed us. So we normally come here and we say, if this is what we sold and received, then we need to know how much did it cost us. So we normally raise the cost of sales or the cost of goods sold. Yes, we sold and we found this, but these goods that we sold and received this amount, they costed us something. So we need to know how much did we buy these goods that we sold at this amount. So we normally start by the cost of the opening stock. As we were starting the year, we had opening stock, and this stock had a cost. And opening inventory or stock, we are given it is 86,200. So we have that. The opening stock is 86,200. And then to this, we normally add the purchases. Purchases, it is simply the cost of additional stock. The cost of additional stock. This is the stock that we started with at the beginning of the year. Then we add the cost of the additional stock that we brought into the business in the course of the year. And the total purchases, it is 274,100. 274,100. I want to confirm whether there is some returns. Agnes, confirm for me. Do we have, once we write sales, we need to have confirmed whether we have the sales returns or return inwards. So I want us to agree. Did we have any return inwards, Agnes? Because I know you have
we only have outwards.
Okay. Return inwards, it is actually the value of goods that were returned by the customers. So we normally subtract from the sales. So purchases is what we bought, and this amount is 274,100. 274,100. But out of these goods that we purchased, some of these goods we returned them back to the suppliers, and the goods that we purchase and then later on we return them to the supplier, they are normally known as purchases returns or return outwards. And those goods or the value of those goods we normally subtract here, because when we bought them, they are included in this figure, but when we return them back to the supplier, we now subtract them from this figure because they are no longer in the business waiting to be sold. We less that figure, which is actually 4,800. And because we don't have the carriage inwards, that is going to be the case. Then can you add for me this? Sorry, subtract, not add. This is a figure to be subtracted from this so that we can get the actual figure of goods that we bought and remained in the business.
$269,300.
269,300. So I want to go back here. This is the stock that we started with, and this is the value of goods that we have added. So in total, how much or what is the value of goods? What is the value of goods available for sale? What is the goods available for sale? The opening stock, the value of the opening stock plus the value of the purchases. It will give you what was available the whole year to be sold. How much? Yes, Agnes.
355,
Three-
355, 500.
355,
500.
500. Those are what are available for sale. Out of those that were available for sale, not everything was sold. So we normally rest what was not sold, and what was not sold is referred as the closing stock. The closing stock. The closing stock was under the additional information 1, and it was actually a figure of 49,300. 49,300. If you subtract that, what do you get? Whatever figure you get there would be the cost of the sales.
$306,200.
You get 306,200. So this is the cost. I want to repeat here so that we can be together. The opening stock is the cost of the stock that we started with. Then we add the cost of the additional stock, which is purchases. But these goods that were purchased, not everything that we purchased were actually in the business, or they remained in the business. For 4,800 were returned back, so they are no longer in our business. So we minus them so that now we can get the value of those goods that were bought or that were purchased, and actually they remained into the business. And actually, remember, we are talking about the cost of buying them. So this is the cost of the stock that we had at the beginning plus the cost of the goods that we added. It gives us the cost of goods that are available to be sold. But what is available to be sold, we have some of them which have not been sold, and it is 49,300. So if we had 355,500 to be sold, and what is remaining is 49,300, then it simply means that 306,200 of the goods is what was actually bought and sold. So we bought these goods at 306,200, but we managed to sell them at 481,000. So if we sold them above the cost, then the business realized what we call the gross profit. The business realized what we call the gross profit, which is simply the revenue that we received from them minus the costs that we incurred. Well, how much is that?
174,800.
174,800, like that. 174,800. After getting that particular figure, which is actually gross profit, after getting the gross profit, you said it is 174?
800.
800. That is the gross profit. This gross profit, it is actually the revenue or the profit that has been generated from buying and selling the goods. By buying and selling those goods, we were able to generate a gross profit of 174,800. To this particular profit, we normally add other revenues. We normally add other revenues. Other revenues the business might get. And other revenues are actually the other sources of finance apart from buying and selling of goods. The business might have some premises which it has let, and then it receives the rent. So we have got the rent income as an additional revenue. We can have things like the discount received. Sometimes the business can do a transaction and then it gets some commission. All that it receives, apart from the amount of money that we receive from selling the goods, that money is normally categorized as other revenue. So in our question here, we had a revenue that is generated from rent. So we can write here rent income. Rent income. And if you can have a look at the rent income, we did some adjustment on it. We did an adjustment on it. And the adjustment that we did was that rent income, there was income that we received and there was 14,100 that was not yet received. So if we add the two, the total rent that we were supposed to receive that financial year, it is 92,300. So the business generated 92,300 as additional revenue that came in from rent. 92,300. Then what other revenue do we have? We also have, we said, the moment there is a decrease in provision for depreciation, you add it to gross profit. And this is the point that we are supposed to do that. So we add decrease in provision for bad or doubtful debts. How much was the decrease? The debt
6460. I think it was 6460.
Let me confirm. The decrease, let me see. The decrease was
2740.
2740. 6460 was the total amount that is doubtful, but the only decrease was 2740.
2740, yes.
That is what we capture here. Would you only capture the decrease 2740? And then I found out, let me find out whether there is any revenue. Actually, there is no any other revenue that came in apart from those three. So can you add for me that?
$269.
269.
840.
840. So that is the total income. From this total income, we come here and we less expenses. We should come here and we less expenses. So we had expenses. Remember, an expense, it is that cost the business is going to incur actually apart from the cost of buying the goods. If there is anything that the business is going to incur apart from buying the goods and buying the fixed assets, anything is now considered to be an expense, and actually those expenses are meant to make sure that the business continues to run and everything goes on smoothly. So in this particular business, there was an expense in the name of electricity. That is electricity expense, which we have actually done some adjustment here. The electricity was having a prepayment, so that 8,500 that was paid, we minus the prepayment, and the amount that was supposed to be payable was 34,800. So we need to capture this amount that was supposed to be payable. So we come here and you say electricity expense. We said it is
34,800.
34,800. 34,800. Another expense that we have in this particular business, it is bad debts. Bad debts, there's a difference between the bad debts and the provision for bad debts. The bad debts are those debts that we have confirmed that they are not going to be payable. Those customers, we are so sure they are going not to pay us. And because of that reason, we normally subtract it and take them to be as an expense. So that figure does not require any adjustment. Always put that figure as an expense the way it is. Then another item is the insurance. Expense, and the insurance expense was 45,100. 45,100. And then there is a depreciation. Depreciation on motor vehicle. Depreciation on motor vehicle. We calculated that figure and we found to be the 36 960. This figure, 12% of that, that is 6,960. Let me see whether there is any omission. So I think all the expenses have been captured and they don't include any fixed asset. So can you add?
The building cost is
The building cost is that is a fixed asset.
okay.
That is a fixed asset.
That's 125,060.
125
060.
060. Those are the total expenses. So
Yes.
generated this income, and then part of that income, and actually 125,060 was used to pay for these particular expenses. So how much will remain? And that is what we call the net profit. The net profit.
144,780.
144, 700,
780.
780, 144. And that is the end of that statement. For a sole trader, once we arrive at the net profit, the story ends there. And we are good to go and prepare the next statement, which is the statement of financial position. So the statement of financial position will only record the assets, liabilities, and capital, those three items. So we also come here and we start with the title, any trader statement of financial position as at 31st December 2015. Okay, we normally start with those assets we normally refer as fixed. Fixed assets. Those assets that are going to be in the business for more than one financial year. So we normally start by recording their cost, their accumulated depreciation, and then if we bought them at this cost, they have lost this to depreciation. The difference between cost and accumulated depreciation gives us what we call the net book value, the net NBV, net book value. So we have the motor vehicle. The motor vehicle, whose cost was 350,000. The accumulated depreciation is the total depreciation. And what we need to do in that case, we need to add this. Remember, this is the depreciation for this year. For this year, like that. And then there was this 42,000 from the question, which was actually was captured as provision for depreciation. This is for the previous. This is for the previous years. So the accumulated depreciation, it is actually the sum of the two. What this particular fixed asset in the name of motor vehicle has lost is actually the sum of these two. As at this date that we are preparing this statement, the depreciation has lost 36,960 this year and 42,000 the previous years. So in total, how much has it lost? Agnes, add from
78,960.
78,960. So if this is the cost, this is the accumulated depreciation, what is the difference? The value at the start minus what it has lost, it will give us the value at this date, that 1st December 2015. What is the figure?
271,060. 040.
271,040. And actually, you underline that. These two, we no longer need their values. We only need the value for the net book value. That's why we underline this, so that any figure that we are going to write below them, we are not going to add them. So we go to what we normally refer as the current assets. The current assets, we underline that. We have inventory, the stock or the inventory, and this one we normally use the crossing figure, the crossing stock, and the crossing stock was 49,300. Then any other, we have the debtors, the trade debtors. The trade debtors, there is actually something that we need to do here. The trade debtors that we had is 64,600. This is what, remember, the debtors are the customers who are supposed to pay us because they bought goods on credit. What we were expecting from them was 64,600, but from our calculation, we found that we have got these people who are actually doubtful. Remember, we are talking about provision for doubtful debts. This 6460, it is doubtful. And because it is doubtful, we cannot continue anticipating for them. What we need to do under the principle of prudence, we erase them. We will erase them, and then we remain with the figure for the debtors that we are sure that they are going to pay. So we less 6460. We less 6460. So that now we can get the figure for the real people who are going to pay us without any kind of doubt. So how much is that?
That is 6460, right?
Yes, this is 6460.
58,140.
58,140. That is what we are expecting to receive. So after calculating the provision for doubtful debt, that figure in the income statement, your work is to look at whether there is increase or decrease, and you capture only the increase and decrease in the income statement. But when you come to the statement of financial position, the figure that you calculated for this year, you minus from the figure for the debtors for this year, so that now we can get the net debtors, or those people who are going to pay us. Another current asset that we have here, it is this prepaid electricity. Prepaid. Any prepaid expense is actually an asset. This one being, sorry.
Mwalimu, I have a question.
Yes.
This building at cost, I thought that's an asset, a fixed asset.
Oh, true. I don't know why I forgot to capture it where it's supposed to be. Let me go back there. Actually, let me capture this one. The prepaid electricity. Yes, actually, we need to go back here. We made an omission. Thank you for that observation. There is a building. There is the building. And the building was how much? 599,000.
Yes.
But it does not depreciate.
Yes.
So the figure remains 599,000. So actually, that was a very good observation. So can you add for me these two? 271,040 and 599,000, so that we can get that net.
Eight 70,040. 870,040.
Okay. And okay, the prepaid electricity was 3,700. And then actually even the accrued rent income, the accrued expense is actually treated as a liability.
Current.
Yes, as a current liability. But when it is accrued income, it is a current asset, because that is an amount that we have not received, but it belongs to us. And the moment it belongs to us, then we take it as an asset, because assets are those items that belong to us. So accrued rent income, and it was actually 14,100. It is a current asset. Let me see, what else do we have here? We also have cash. I don't know whether we have bank. Do we really have bank?
Mwalimu, where does capital fall in?
Capital
Yes.
will come later. Now we shall go to the section where we shall capture capital and liabilities.
Okay.
Yes. We don't have bank. We only have cash. How much was the cash?
21,600.
Yes. Can you add those current assets? This is 49,300 plus 58,140 plus 3,700 plus 14,100 plus 21,600.
146,840.
146,840, yeah?
Yes.
So can you add now that one to the net book value of the fixed assets?
$1 million.
1 million.
016 880.
Those are now referred as the total assets. Those are the total assets. The figure for the fixed asset plus the current asset. Once you have captured that, we now go to that section. That is capital and liabilities. Capital and liabilities. So we start with the figure for the capital. Capital is how much? 842.
842.
842,500. Don't forget to add the net profit. The net profit that we calculated. There's a net profit that we calculated here. And the net profit was actually 144,780. 144,780. This is 4. And then if there is drawings, can you rotate drawings?
Yes.
Yes.
19,500.
That drawings it reduces the capital. So you raise the drawings. Drawings is supposed to be subtracted from capital, 19,500. So can you do for me this work? 842,500 plus 144,780. 842,500 plus 144,780. Then you minus 19,500.
967,780.
967.
780.
78, yeah?
Yes.
And then we go to liabilities, and I think the only liabilities we have, they are current liabilities. That is we go to the current liabilities. And the current liabilities that we have, I think it is the trade creditors. These are actually the suppliers that we are supposed to pay. Trade creditors amounts to how much? 49?
49,100.
So if you add that to the net figure for capital,
The 967.
yes, you add it to 967,780.
Uh, 1 million 016 880.
1 million zero
016
uh-huh
880.
That is the figure for what? Capital and liabilities. And
Yes.
then now you compare with what we got here. Is it the same?
Yes, it is.
Total assets and the capital and liabilities. They are giving us
Yes.
the same thing. And that one is in conformity. That is in conformity with what we know, that assets must be equal to capital plus what?
Plus liability.
Liabilities, from what we discussed about the accounting equation. And for sure, the total assets that we got is the same as the figure for capital and liabilities, meaning that every transaction has been captured the way it is supposed to be captured. So the point I want to emphasize is actually on the adjustment. Anytime you are given the additional information, just spend.
Mwalimu,
Yes.
you said assets equals to
Capital plus liabilities.
Oh, thank you.
Okay, karibu. So anytime this question is given, if there is an additional information or the notes, you should always start with them and do all the adjustments before you proceed to preparing them. And when it comes to accruals and prepayments, accrued expense, it is an expense that has been paid in excess. Therefore, we minus. Sorry, not accrued, but prepaid. Prepaid expense is an expense that has been paid in excess, and therefore we subtract. But accrued simply means that it has not been paid, yet the time for payment has already passed. So what do? We add it because that amount of money has not been paid. We add it so that we can be able to get the total amount that was supposed to be paid for that particular financial year. Okay.
Question, Mwalimu.
Yes.
Because part B, the question was prepare the balance sheet as at 31st December 2015. So is that the same as the statement of financial position?
Yes. Actually, the statement of financial position is the same as the balance sheet.
Okay.
And the income statement, it is the same as the profit and loss account. So sometimes you can find them, they tell you prepare the trading profit and loss account. The trading profit and loss account is what is known currently as the income statement or the statement of comprehensive income. Another question.
So you said income statement is the same as a profit and loss?
Trading profit and loss account.
Oh, okay.
Trading profit and loss account. They are the same.
That is where my confusion has been.
No, they are actually, previously, actually some 6 or so years ago, they used to be known as the trading profit and loss account, and the other one, the balance sheet. But currently, it is very, very rare for you to find them being used. They normally use the income statement and the statement of financial position. Emma, I can see you joined. Ola, she's not with us. Emma?
Yeah, Mwalimu, yes, Mwalimu.
Oh, you are here, eh?
Yeah, I had a problem with my network, but I've sorted it.
Okay, that's okay. I want you now to give me the areas that you...
So income statement is the profit and loss, isn't it?
Yes, yes.
Yeah.
Okay.
Mwalimu, I think we were to do the bank reconciliation.
Bank reconciliation statement, eh?
Yes.
Okay, let me go there. Bank reconciliation. Bank reconciliation statement. I will start by saying this. The bank reconciliation statement comes in as a result of one fact. Because the business will prepare, it's actually what we normally call the cash book. Eh? The business will prepare the cash book. And then if the business has got the bank account, money might be received through the bank account or through the checks. At the same time, payments can be made through checks or through the bank. In the business, the accountant prepares that document we call the cash book. So the accountant is in the business and is preparing the cash book. And then that money is either received by the bank or it is withdrawn from the bank. Therefore, the bank will be preparing what we call the bank statement. Ideally, the cash book should have or should be identical to the bank statement, because everything that we receive, we take it to the bank if it is a check. Every check that we pay or we give to a particular person, that particular check is taken to the bank. So whatever we have recorded in our cash book and whatever that is recorded in the bank statement should actually be the same. But many are those particular times where the cash book balance and the bank statement balance are not the same, yet they are supposed to be the same. Now, we normally wonder, what are the reasons that make this particular or make these statements not to be the same, yet they are supposed to be the same? Because it is capturing the same things that we are receiving, the same things that we are issuing out. That is what they capture, both of them. So the moment the two of them are not in agreement, then we go ahead and do what we call reconciliation, which is actually the process of making them have the same balance. And the reason as to why the two documents disagree is because of, let me have the cash book on this side. And on this side, we have what we call the bank statement. What is making these two documents not to be the same? The reason is obvious. Some items are in the bank statement but missing in the cash book, while some items are in the cash book but missing in the bank statement. Whenever we have that kind of a scenario where an item is in the bank statement but it has never been captured in the cash book because the accountant is not aware, or an item has been captured in the cash book but has not been captured in the bank statement, obviously the two balances will not be the same. So those items that are going to be in the cash book, they have already been recorded in the cash book, but they are not in the bank statement. They are categorized as unpresented. We have what we call unpresented checks. And we have what we call uncredited. The uncredited checks. So what you need actually to remember is one thing. When we talk about unpresented checks, these are the checks that are paid, the checks that have been paid out by the business. Whereas the uncredited checks are the checks that we received, are those checks that we received. So unpresented checks, they simply mean the checks that we have given out to our suppliers or our creditors, or we have paid our creditors by the use of checks, so we have given them, but they delay presenting that particular check to the bank. They don't present it in a timely manner, such that by the time the bank is printing the bank statement for that particular period, this check has not been presented there, and you'll find that that particular check, it is not going to be in the bank statement, but the accountant, once that check was issued out, the same day that check was recorded in the cash book as a check that has been paid. But the person who was given the check did not present it to the bank for payment. The bank is not aware, and therefore that particular check is not going to be in the bank statement. The other item that is going to be in the cash book but missing in the bank statement, it is what we call uncredited checks. Uncredited checks are those checks that we received as a business, but as either we delayed taking that particular check to the bank, or we took that particular check to the bank when it was almost the end of a period. And we know more often the checks are supposed to take maybe 2 or 3 days before they are cleared. So by the time they are cleared, the period has come to an end and the bank statement has been printed without their inclusion. And therefore, they are already in the cash book as received, but they are not in the bank statement as received. That is another very, very important. So these two items, the unpresented and the uncredited, they are already in the cash book. But when you try to trace them in the bank statement, they are not there. And as I've said, these are the paid out checks. These are the received checks. The other side, you can find some items that are in the bank statement, but they have not been captured in the cash book. And these items are items like the bank charges, items like the bank charges, items like the standing orders, items like the dividends received, items like direct deposit. So if I can explain each one of them, bank charges are the charges that are levied by the bank to the account holder, or those charges that the bank will actually charge because of maintaining our account. So you find that the bank will charge or will deduct our account without just a minute. So I was explaining this. The bank charges are those charges that are levied by the bank for maintaining our account. And you find that when the bank is charging those particular charges, the business is not aware, and therefore it is not going to be captured in the bank statement. The standing order. This is a case whereby a business or the account holder instructs the bank to be deducting a certain amount of money regularly to pay a certain expense. If, for example, a business has got a loan, if, for example, the business has got a loan that is payable 1,000 every month, a loan of 1,000 every month, instead for the business going to the bank every other month to transfer that money, we can just issue a standing order and that money is transferred directly from our account to the account for that particular loan. So it is actually a payment that is made on behalf of the business by the bank. Then the dividends received. This arises if a business has got some investment. If the business has got some investment, then the business can receive those dividends. And when these dividends are coming into our bank account or the registered bank account, the accountant is not aware. So he's going also to find them when the bank statement is printed. Then we have got what we call direct deposits. Direct deposits are actually the money that we have received from our customers who went and deposited that money in our bank account without telling us. If I have your bank account, I have your bank details, and I have your debt, I just go to the bank and deposit that money in your bank account, and I don't tell you. So you are not aware of that, so that you can be able to capture it in the cash book. So at the end of the period, when you ask for the bank statement, that is when you find that so and so paid without your knowledge. That is a direct deposit. And the other item that I omitted here, it is called the dishonored checks. Dishonored checks. And a dishonored check, it is a check that has not been accepted by the bank. So it is a check that we received, but upon taking it to the bank did not honor that particular check. So it is a check that is supposed to be cancelled from the cash book because it was received and recorded as received. But when we took it to the bank, it was not accepted. Because it was not accepted in the bank, therefore, even in the cash book, it should not be there. So we need to cancel that particular check. And whenever this question is tested, you will be required to prepare 2 items. You will be required to prepare a document we call updated cash book. You will be required to prepare updated cash book. An updated cash book, it is a cash book that is meant to update the cash book that was initially prepared. Remember, we have agreed some items are already in the bank statement, but they are missing in the cash book. If they are missing in the cash book and they are supposed to be there, then we have a responsibility of including them there. We include them there. So this is actually the credit side, and this is the debit side. We should always start with the balance brought down. And balance brought down, it is that balance that was in the initial cash book. That cash book that we prepared and we compared with the bank statement, the balance that was in that cash book is what we put here, and we make the adjustment. So remember, the debit side of the cash book, it is meant to record the receipts. Receipts simply means that money coming in, whereas the credit side, it is meant to record the payments. Payments meaning money moving out. So on the receipt, we record that, or the money that we received in the bank account, but was not recorded as received in the cash book. So we have things like dividends. It is an amount that was received in the account, but was not recorded as received in the cash book. So we record it in the receipt side. Now that we have the bank statement and it is known, we have the direct deposit. Direct deposit, we include it here because it is money that we received in our bank account, but we were not aware that it was received. So we also include it here. Then on this side, we have the payments. Payments or money that was deducted in our bank account without our knowledge. And that one will comprise things like the bank charges, the figure for the bank charges, the standing order. The standing order, remember, this is an expense that is paid to us, or paid on behalf of us. And then the other thing that you should remember to include here, it is what we call the dishonored check. We include it here because that check was received in the cash book, but it has been dishonored. So we record it on the credit side so that we can cancel its effect. So that we can be able to cancel its effect. Then lastly, now you are going to get balance as per updated cash book. Balance as per the updated cash book. And we put that figure here. And then now we get the totals. Like that. Once you have updated your cash book with this item, and at this moment, I can say this. When updating the cash book, always use items that are in the bank statement, but missing in the cash book. We only use these items to update the cash book. Items that are in the bank statement already, but they are missing in the cash book. Because they are missing in the cash book, now we include them, now that we know that they occurred in that particular financial period. So never use the unpresented checks and uncredited checks in updating your cash book. And the reason is they are already in the cash book, so you cannot add them twice. Already they are in the cash book, so you only use this because these are being omitted in the cash book. So having said that, maybe I can give you the format of that, the bank reconciliation format. Bank reconciliation statement. The bank reconciliation statement, you can start with the balance as per updated cash book. The balance as per the updated cash book, the figure that we found in the updated cash book. Then you add unpresented checks, the unpresented checks, or alternatively, I can put them here. The unpresented checks, we put them there so that we can add the two of them and get that figure. Then we less uncredited checks. The uncredited checks, we get them there so that now we can get a figure here. So balance as per the updated cash book, add unpresented, less uncredited. The figure now you get there is balance as per bank statement. Balance as per the bank statement, and you are done. That is how you are supposed to go about that question. Maybe we can look for one that we can do very fast. So if you can look at, this is June 2019, June 2019 question 5. June 2019 question 5. June, okay. The question reads, question B. The following cash book and bank statement balances were given by CASIP traders for the month of December 2018. We are given the cash book balance and the bank statement balance. Then, during the month, the following transactions were recorded. 400,000 had been deposited directly into the bank. That is a direct deposit. There was a standing order of 136,000 to pay rent. And then you are told that the following creditors had been paid. So, and then you are told that these amounts were not in the bank statement. So if they were paid and the amounts are not in the bank statement, then they are unpresented checks. They are unpresented checks because from what we said here, unpresented checks are the checks that have already been paid. The checks that have been paid, but they have not been presented. They have been paid out. So we paid those creditors, but those creditors, they delayed presenting the checks for payment. And then electricity expense was recorded only in the bank statement. So if it was only in the bank statement, we put it in the updated cash book. So I want us to go straight and do that question. So we start with the updated. The updated cash book. The updated cash book, always start with the balance brought down. Always start with the balance brought down. And the balance brought down is 235,000 for the cash book. 235,000. Then identify those items that are in the bank statement only. And then we have these things like the direct deposit. We say the direct deposit will come here. Direct deposit will come here, 400,000. Then standing order, it is a payment, will come here. Standing order, it's a payment, it will come here, 136,000. So it is credited and any income is debited. And then the following creditors had been paid by check and they are not in the bank statement. Those are unpresented, and we said unpresented and uncredited cannot be used to update the cash book. So we leave them. We shall use them in reconciliation. Then number 4, electricity expenses of 4,000 was recorded only in the bank statement. So if it was only in the bank statement, actually it is an expense. And an expense, it is actually a money moving out, so that we should record it here. 4,000 electricity. This is actually electricity. And then the following debtors were paid. Actually, it's supposed to be the following debtors paid by check, but the information was missing in the bank statement. So these are uncredited. And then we are given the bank charges. The bank charges. And the bank charges are that 5,000. That is a payment because it's a deduction from our bank balance. So can you get the balance as per the updated cash book? So what you need to do, you need to come here and add the total receipt. 235,000 plus 400,000. What do you get? Is it 635,000? And then 635,000 minus this one is 140, 175,000. 635,000 minus 175,000 is going to give us what? That is now the balance.
460.
Balance as per updated cash book. You said how much?
460,000.
For 60,000. So that now we can have them agreeing at 635,000, like that. So we are done with the updating the cash book. After updating the cash book, now we go to the bank reconciliation statement.
Mwalimu, please go back before we
have
finished.
Yes.
That is balance as per updated
Cash book. Yes.
Okay.
Yes. For 60,000. Then we go to bank reconciliation. Bank reconciliation statement. So with the bank reconciliation statement, we normally prefer starting with the bank balance. Sorry, it's supposed to be balance. Balance as per updated cash book. Balance as per updated cash book. And that balance, what was the figure? The figure is for 60,000. So we should come here and record it as 460,000. Then you add unpresented checks. You add unpresented checks. And the unpresented checks, we know, are the checks that we paid or we gave to the creditors, but they delayed presenting them. So we have the check from Musa, Ann, and Odhiambo. So can you add this figure? Musa, Ann, and Odhiambo. For Musa, it was 175. So add 175 plus 290 plus 325. 175 plus 290 plus 325.
790,000.
790,000. Can you add that one to 460,000?
$1,250,000.
Okay. Then we less uncredited checks. The uncredited checks, they are from Wote, Zeb, Kiki, and Susan. So can you add 61,000 plus 43,000 plus 120,000 plus 56,000? $61 plus 43 plus 120 plus 56.
280,000.
280. And this one we are lessing. So what do you get?
Nine 970.
970,000. Balance as per bank statement 970,000. Is it the same that we were given in the question? Bank balance, bank statement balance.
Yes, 970.
If they are the same, then we have reconciled. Then we have actually reconciled. That is what was expected of the student for that particular paper. Any question? I want to end there for today.
Asante sana mwalimu.
Yeah, karibu sana Musangi.
Although I want to know how these figures are arranged, because I've seen that they are not all following one another.
Yes.
When we were doing the Mweni trader income statement for the year ended the 31st.
Okay.
I may just want to know.
Yes.
What figures come to the far end? What determines what is going to the far end?
Yes.
And what is coming to the left?
The middle and the left, huh?
Yes.
Okay. The trading.
Yeah, like this one now,
Yes.
you see like 352 where it is.
This one.
The screen, eh?
Uh-huh.
You see there are like 3 columns.
Yes, there is actually 3 columns. Huh? You know, this
Yes.
on this statement of financial position, there is this element we call the fixed assets. Huh? These fixed assets, they have a tendency of depreciating, losing value. Eh? So the first column here, we normally put their cost, the price that we paid when we bought them. Eh?
Yeah.
The second column, we minus the depreciation, or we put the figure for the depreciation. And then last column here, it is what we call the net book value, which is actually the cost minus the depreciation. We get that net book value. For building, the cost was 599, but it was not depreciating, so the net book value still remains 599,000. And then we shall operate with this. Having obtained the value for the net book value of the fixed asset, we now get the value of the current assets. So because the current assets don't depreciate, we normally use the second column to add their values. We normally add their values, and then we bring their total to be vertical or to be below the net book value total, so that now we can add the net book value and this one to get the figure for the total assets. So this part, it is only meant to add for summation, and then we bring the total here, so that now we can be able to see that. When it goes to the other one, the statement of finance, the income statement, let me just go up. For the income statement, the sales is normally put on the far end. Then when we go to the cost of sales, the opening stock, we normally put it in the middle column. We normally put it, actually we have another one here. I'm supposed to write here shillings. This one, the cost of sales, the opening stock in the middle column, then we add purchases. In most cases, you realize that purchases need to be adjusted in one way or another. We purchase goods, we have returned them, we pay the transportation cost. The adjustment for the purchases is normally done in the first column. So purchases plus carriage minus returns, we put them here. And actually that will be the end of the first column. The first column in the income statement is only and only meant to do the adjustment for the purchases. Purchases figure, add carriage if it is there, rest return outward, so that now we can determine the value for the net value for the purchases. And then after getting that, we less the closing stock, and then we get the cost of sales, which now is put directly below the sales, so that now we can minus the sales minus the cost of sales for us to be able to know the figure for the gross profit. So this first column for the income statement, it is only meant to do some adjustment to the purchases. If the purchases does not require adjustment, meaning that in that question you don't have carriage outwards, carriage inwards, and you don't have purchases returns, then the figure for purchases, you just bring it directly below the opening stock, and you add it to get what is available to be sold. So note that the first column only to adjust the purchases, and then we shall be operating the two. Is it okay?
Yes, mwalimu.
Okay, asante sana.
Thank you.
Okay, karibu. Can we?
Question.
Yes.
Where we are adding purchases there, if
Yes.
we had return inwards, so we would have added.
If we had return inwards, we normally subtract from here. Remember, return inwards, there are sales returns.
So we add to the...
We less. We minus from sales. So we could have written sales for 81,000 less sales returns 1,000. Then we get for 80,000. That could have been the net sales. Are you getting it?
Okay.
Yes.
Okay.
And then we proceed. But in this question, there was no sales returns. So whatever we sold went No customer returned some of the goods that we sold to them. Any other question?
If you miss out one or two things, what happens? How is it marked?
You continue getting the marks for the subsequent entries. But the only thing you are going to find that your work will not balance, but still you are going to score good marks if the other entries are going to be correct.
Okay. So if the question is hard, we just still attempt.
Just attempt. If you know that sales is supposed to be put here, put it there. Say less cost of sales, you know where opening stock is supposed to be put. Just attempt.
Okay.
Accounting only entries. We are interested with entries. You can score very good marks actually without any of your account balancing.
Okay.
You can score very good marks. Just actually note the format of every statement. If it is the cash book, how does it appear? You have the format right. If it is the bank reconciliation, how do we prepare it and how does it appear? You just have the format right. You find that you are going to score very good marks and also be very neat, not like mine here.
Okay.
Okay.
So the control accounts.
The control accounts, we shall start with that.
Yes, kindly.
Okay. And then
And
our class
errors.
Okay.
Or errors and control accounts.
Okay, no problem.
So Mwalimu,
Yes.
Return inward and return outward.
Yes.
Goods that have been sold and have returned back are the return inward.
Inwards, yes.
And the ones that we have purchased and we have returned to the supplier
are the outwards, the return outwards.
Okay.
Yes,
Thank
yes. Karibu. Okay,
so we will be having our classes
Thursday, normal hours. Actually, we have pushed our class back to Thursday from 6. From 6 so that we can have, because actually even me, I normally do this one from the office, so that at least if we have it from 6 to 8, at least I will have enough time to beat the curfew.
Oh.
Yes, yes.
Paul, we inconvenienced you without knowing.
No problem. Let us go back to Thursday because of everybody will be comfortable there.
Okay.
So we start at 6 so that we end approaching 8, and then.
So you don't want 7, Mwalimu?
7 will be a bit late. You know, now it will push us almost to 9.
Curfew.
Yeah, curfew, it is at 10. Now we must have a big margin for curfew. Yes, actually 6 will do as well.
Mwalimu, can you now send me the recording for the last class?
Kindly, can I do it when I get maybe in the house or very early in the morning? I will share with you.
Yeah, no problem. Thank you.
Karibu sana. Enjoy your evening.
You too.
Okay.
Hello, Mwalimu.
Yes.
I'm also requesting the record.
The recording for today?
Today and the last class.
I'll share it, and I think Agnes.
Yes, Mwalimu.
Kindly let us have a group for us. Can you have a class group, WhatsApp group?
We actually have Mwalimu, and I think you're there.
I know there is the other one, but you know the other one is for the managers.
Okay. Okay.
So
now the rest of the members, I'm not so sure I have your numbers.
But you can extract them from the other one.
Oh, from the other one. Yeah,
yes,
you're right.
Yes.
Yeah, let me create that.
Okay. And then you add me. Then I will be sharing those recordings there.
All right.
Yes.
That would be good. Asante sana.
Karibu.
Thank you, Mwalimu.
Okay, asante sana. Enjoy your evening.
And
you too.
Okay, thank you, Mwalimu.
exam papers, eh?
Exams paper, if you can be able to log in to your portal, there is somewhere written past paper, but don't mind, I will share with you via email.
Okay.
Just send me your email address and then I will share with you.
Thank you.
Okay, karibu.
Okay, thank you, mwalimu.
Okay, karibu sana.